Hi, I'm Midas of Midas Investing. This new format is new not only that it's a video rather than a live stream, but we're also debuting our new spreadsheet tools that we're going to be using for our live valuations going forward. I'm also going to be doing live streams to go over market happenings and portfolio updates and screening of stocks, probably on a weekly basis, so you can keep an eye out looking for that. But we are changing our format for the valuations from a live stream to video moving forward. If you appreciate these changes and are also just excited to get into this stream today, we really appreciate it if you give us a like, as well as subscribe to the channel if you're not already. And also consider joining the Discord, which is in the link in the description below. So today we're going to be taking a look at ticker ATKR, Atkore Inc., which is a creator of building products and electrical equipment used in building applications. They offer a variety of products, including conduit, cables, and installation accessories, a variety of brands under their umbrella, including their main Atkore brand, but also Allied Tube and Conduit, AFC Cable, and kaf-tech, as well as their recently acquired United Poly Systems. Hopping over to their recent earnings presentation for the full year, they actually have quite a lot of information that I'm going to go through here that I found very, very useful. Taking a brief look at their overall performance on the year, they had 34% increase in sales, 55% increase in net income, which led to a 67% increase in diluted EPS. Coming down here, they show a historical net sales bridge going all the way back to 2017 up through 2022, showing basically similarly to what we had already seen. The vast majority of the growth in the revenue has actually come from pricing changes over the entire time frame, which is pretty interesting to see that it's not just these last 2 years where there's a huge inflation overall pricing, that's basically what a substantial amount of their growth of revenue has come from. The second largest source being from M&A. That's been a very, very huge portion of their overall growth, which we're going to definitely be getting into as they actually kind of talk about here, specifically narrowing in on the adjusted EBITDA metric that they have. They break it down, the larger amount that's left from the pricing amounts here. They actually estimate how much of it they see as pricing outperformance, particularly from commodity price inflation in the last couple of years versus the portion that they see more as a sustainable level that they can have towards the future. I did a little bit of some backwards math on the relative the relative percentage of their gross margins to their operating margins, which I saw is reflecting the difference between the leverage that they get from their sales all the way down to their EBITDA, and then took the amount that they saw as a sustainable amount to basically figure out what portion of their sales do I think could possibly drop off based off of the sustainable pricing estimation that they did. So I estimated that based off of their estimation that they're going to lose about 585 million of EBITDA based off of pricing outperformance coming back down to reality. I estimated that's maybe close to $1 billion in terms of total sales, which means you can see 3.9 billion actually be more like 2.9 billion, maybe 3 billion after this pricing starts to normalize, which they're going to get into in some of these other slides. They also talk about how their addressable market has changed since their IPO in 2017, showing that they were a little bit more focused specifically on metal conduits and metal framing. A little bit more specifically, that made up about half of their business between the two segments. And now with the huge growth, relatively speaking, in plastic piping and conduits, that itself has become now the largest section of their business and really balances out the other sections of their portfolio. Now over here, they actually make a pretty large amount of relevance in this in their earnings calls about the Architectural Billings Index being a kind of forward index of the relative demand of their products. Now I'm not necessarily super convinced on how qualitative this index is. I haven't looked super much into it, but it is worth noting that since this presentation came out, this index has actually dropped a little bit further, now down to 46, 47 level relative to the above average level that they were seeing before. So you could take this as a little bit of a warning sign on the forward end relative to what they have going on, as well as you can see construction backlog has started to tip up, relatively speaking, which is also a little bit more of a headwind to demand moving forward. All right, now here in this section of their presentation, they actually also apply some really, really useful slides, I think, for giving us a good picture of how we're going to build up our valuation for ourselves. First, giving a little bit more of an overview of their growth profile over the last 5 years or 6 years, showing their 21% growth, the CAGR of net sales, which is truly outstanding, 46% CAGR in free cash flow, also outstanding. And then they also showed their debt maturity profile, showing that they don't really have much debt maturities going on until 2028 and even further past that, 2031, giving them kind of a weighted average debt maturity that's pretty solid, up around 7 years or so, giving us a little bit of forward outlook for 2023. They're expecting flat to down maybe 10% sales versus the prior year in terms of net sales, which is pretty useful for what we're going to be taking a look at. That does go pretty solidly in line with the analyst expectations that we have right here of about 3.7 billion according to 5 analysts for 2023, which is down about 5 to 6%. And then they're seeing a small bounce up past that point to 3.82 billion in the year after that. It's also worth noting while we're here at Yahoo that equates to approximately an adjusted EPS of about $14.50 for this next year, and then maybe about a little over $15 for the year after that. Which, kind of getting into that, they talk about their expectations for capital deployment, targeting cash flow from operating activities to be approximately 100% of net income average over a 3-year period, and they expect to maintain gross debt to normalize adjusted EBITDA ratio of around 2, which means they want to maintain about a gross debt to normal EBITDA of around 2%, giving them opportunities for strategic growth versus pay down. And then, as we kind of already talked about, they have a huge amount of share back authorized that they plan to put to work over the next few years. They also put together this really neat sales bridge over the next several years, moving outward towards fiscal 2025, or so next 2 to 3 years at least, for that matter, showing that they expect to see a somewhat growth in volume benefits as well as the MMA contributions. And then this is that price normalization that they're expecting, which I kind of compared to my own price expectations. I think it's relatively in line with theirs. Mine is maybe a little bit worse than theirs, but they're seeing it come down to $13 to $15 for fiscal 2023. I think my estimation gets us maybe towards the range of like $12 to $13, but we're getting ahead of ourselves. And then they see also future potential changes to the pricing, as well as general growth of the business, more capital deployment, and then changes in overall capital costs, leading them to an expectation and slash goal of around or greater than $18 in adjusted EPS for 2025. Like I said, kind of spoiler alert, my personal EPS expectations kind of equates to maybe like $14, $15 or so, but we'll get into that in a minute or so. Now, hopping over to their 10K, which they recently released, to kind of get a little bit of a focus on who it is that they interact with business-wise, who are their customers, who are their business partners, the suppliers, and other such major workers that they have to operate with. The 10K is usually a pretty good source for hints of the type of operators that your company is working with. And I found that Atkore was actually relatively forthcoming compared to a lot of companies. I generally tell people you better reading the 10K. They give you all sorts of information, especially in like the risk sections. As I say here, customers include global electrical distributors such as Consolidated Electrical Distributors, Graybar Electric, Rexel, Sombar, Wesco International, independent electrical distributors such as U.S. Electrical Services, Kristen Electrical Supply, members of buying groups, affiliates, IMARC groups, staff of the big box retailers such as Home Depot, as well as many other OEMs. As well as they also gave, like I said, lots of more information related to suppliers. I mean, steel suppliers, including Cleveland Cliffs, Steel Dynamics, Nucor, which is pretty interesting, showing the kind of circular relationship they have with a lot of people, because their suppliers is also pretty relevant to their competition. And I mentioned that in particular related to Nucor, because Nucor is also one of their competitors in terms of the electrical space, being a major electrical and steel creator, but also other electrical competitors being Zekelman Industries, Mitsubishi Corporation, Duraline, and Encore Wire. We've actually valued Encore on the channel before. And in the safety and infrastructure segments of the business, more of Zekelman, Eatman Company, Eatman Corporation, my bad, Hubble Incorporated, nVent, Hayden Corporation, as well as many others. And then while I'm at it, another great place to get information on potential competitors when a company isn't being as forthright as Atkore is in their 10Ks. You can come down a little bit further in the section. They usually have this little bit where they talk about their returns over a certain cumulative basis compared to a peer group. And that peer group is usually identified either specifically like they did here with 10 specific peer groups, including some of the ones we mentioned earlier, but that's some more competitors that we can compare to Atkore. But some companies, they just list an index in here, at which point you can just go look at the components of said index for ideas about related companies. And then moving further down into the 10K down here in note number 10, where they talk about the inventories, which kind of just relates to a general overall topic that we've had with a lot of our valuations lately, which is about rising inventories and how to think about rising inventories relative to sales, and whether or not a company has too much inventory, and whether all these companies that are building up all their inventories are going to regret it in the future, and which ones are going to regret it more than others. Well, I've been kind of like trying to think more and more about how to approach this. And obviously, it kind of comes down to different companies having different rules for their inventories. Specifically, Atkore uses what is known as a LIFO method, which is called last in, first out, which is to say specifically that they are sending out to their customers of the inventory that was most recently put in, specifically so that it reflects the most recent cost that they had in their company. They think this reflects for their company the most accurate reflection of the cost of the goods that are going out. But what this has an effect on in terms of the building up of inventories is that the finished goods that end up building up over the course of time as of total goods build up in the inventory ends up being older and older models of your goods year by year. So as you start to outmode these products and they start to be replaced with newer models or newer upgrades or something like that, then you end up with older outmoded material that eventually has to be sold at a massive discount or eventually just be discarded. So one way I'm just going to start thinking about this in the future is really coming to the note section, where most companies have an inventory note section where they often will break down which portion of the inventory is finished goods versus not finished goods. And I'm going to be thinking about like what was the finished goods level in the previous year versus the now finished goods in the next year, and kind of the difference between that I'm thinking of as like the amount of inventory that's going to be at risk. Like for between here, you can see that it grew something in the range of about 80 million or so, a little over 80 million. From 145 million up to 227 million. So you could say that that growth of the inventories, because it actually grew, as you can see, well over 100 million, less than 200 million, a little bit less than 200 million over the whole course of it. But I would argue that maybe about 85 million of that is the portion that's worrisome, because it means that it's new finished goods that were built within the last year, which means those are the ones that are most likely going to be used, is that 85 million versus the 145 is old. So in one sense, you could say 85 million is at risk, but possibly up to 145 million. Just a thought I've been having on how to think about inventories moving forward. I'm going to start thinking about what rules, whether it's FIFO or LIFO or something else that a company uses, and how that relates to the overall proportionality of finished versus non-finished inventories. So lastly, before we actually take a look at the company financials specifically, coming over to our industry data set tool that we have over here, I've kind of narrowed in specifically on building materials and electrical equipment, which I think are pretty relevant to thinking about Atkore. I think in terms of the actual group in which Atkore falls, I think the of Demodron's data sets where this comes from, I believe that they actually apply specifically as an electrical equipment company, but as we kind of discussed between the different segments, you can kind of consider them a little bit of both. Unlevered beta of 1.17 versus 0.96, and that kind of depends on obviously the leverage levels of the company. If you think about the leverage that these companies have on average over a longer term time frame, it was 28% for maybe building materials versus like 18% for electrical equipment, so kind of maybe around 20% somewhere in between. A little bit more recently, it's more like 18-19% versus 13-14% for different industries. We can also think about the margins that the industries has. Gross margins for building materials is kind of like mid 20s, upper 20s versus low to mid 30s for electrical equipment. So something between that range. And then also adjusted operating margins, we get maybe around 11-12% on the high end, maybe more like 9-10% over a long-term time frame for building materials, 12% more recently, but maybe possibly 12-13% over a longer-term time frame for electrical equipment. So that kind of gives us an idea of where Atkore could be in terms of margins. Maybe anywhere between 9-13% is a pretty reasonable range of operating margins in the long run for the industry. And again, that's the industry. It's not taking into account what Atkore is. We're going to take a look at Atkore. And then gross margins, it could maybe be something in like 25-30% range. Now it's worth noting that Atkore does actually have pretty high margins in the most recent few years. And very, very high gross margins, which is kind of what we were talking about in terms of the price normalization that they have on the presentation bridge that they had. So we are going to have to be thinking in terms of like from where they currently are versus these kind of longer term industry averages, and like how far down towards the average we expect them to go over the long run. Also, in terms of sales to capital ratio, which is the capital efficiency number we'd like to think about for determining capital expenditures for the future. For building materials, it's something like $2.72 of sales for each dollar capital invested in the business. So with that, we can come over to our new spreadsheet templates. I kind of have different spreadsheets to operate for different functions of the overall analysis. One spreadsheet for the financial statements, another spreadsheet for pricing and taking a look at the pricing history, and another spreadsheet for the actual valuation. The reason why I ended up doing it in separate tools like this rather than just doing it all in one, which was kind of the original purpose, is that the tools I ended up building ended up being so complicated that they weren't going to function very well if they weren't in separate spreadsheets. So I kind of built it out this way. So we're going to start over here on the page where I have the shares outstanding. I have financials for 10 years of annual financials, as well as 5 years of quarterly information. And I kind of built in as much of the information I could on the quarterly basis for those 5 years, and then just kind of relied on the annual information for the back 5 years prior to that. As you can see right here in this chart, I have the average price for each quarter as it comes through of the stock in that period. It's the average of the daily closing price during that period, as well as the price change during that time frame. So you can see that, yeah, there is some buybacks being done consistently throughout the entire time frame, though there was also some issuance years as well. Also, as you can see, a pretty large major buyback being done way back in 2018. Not super relevant to the story today. What's really more relevant is the share buybacks that we were doing up here. And yes, the kind of elephant in the room is that they were doing share buybacks as their share price was rather exploding. And so on one hand, you could kind of argue that that's a negative hit against them, but they also just had lots of excess cash flow that kind of had to go somewhere. Otherwise, it would be kind of draining down on the overall returns on invested capital. Coming down to this other chart, we have the actual change in average diluted share count over time. And then this is the change in the average price over on a quarterly basis, so a quarter over quarter change. So you can see whether there was actually a large upward movement in the price in any given one period and how much of that they had going on during that time frame. So I would argue that at least in the last few quarters, they're going in the right direction, which is to say that we have some negative quarters going on, and we can actually see a little bit more of a substantial dip in the shares outstanding. So hopefully they can kind of keep that trend up rather than the previous trend that we were kind of talking about more on the rising tide. So switching over to the income statement portion of the spreadsheet, I have 10 years worth of their annual financials listed here. As you can see, their annual revenue going from 1.4, 1.5 billion up to 3.9 billion or so, with operating income going from 38 million up to 1.2 billion. That's pretty insane growth in operating income. Net income going from negative 61 million up to 913 million. EPS going from negative $1.50 to $20.63 at the end of the most recent fiscal year. I do also have quarterly statements, which also then convert into trailing 12-month statements, but we're primarily just going to be focusing on the annual statements for the income, cash flow, and the balance sheets. And then I also do have graphs to kind of make it a little bit easier to take a look at some of the information in kind of a summarized format. We have the share price here in green with the EPS kind of backdrop against it, and then the kind of areas back behind that are showing the total revenue and the growth of the operating income and the net income. So yeah, pretty kind of consistent growth, but definitely much more mild growth that you can see here in terms of revenue. If we got rid of the most recent few years, this would look much more substantial because it's still going up a pretty solid way over only a few years period of time. But then this explosion in the last few years really just kind of dwarfs it by comparison. Coming over to kind of take a look at the overall margins, which is in the shadings in the background, we can see that they had very, very low operating margins, negative net margins, and then these margins did kind of start to normalize between kind of 2016 to 2020, kind of normalizing in this kind of 12 up to 11 to 12 kind of range for the operating margins, which kind of goes in line with the industry data set that we were kind of seeing right there that was putting them more in line with what you would expect for their operating margins. And then in the most recent years, it's exploded up to 27%, 32%. And again, that's on the backs of the explosion in the gross margins. We have the gross margins versus the cost of goods up in here. The gross margins in the most recent years have exploded up to 42% or 38% in 2021 versus before that we were in 27, 25, 24 kind of range, which is again back more in line with their industrial average, which is again why I am asking the question of where we see the operating margins going in the future. Because the operating margins, if you project your valuation based off the idea that they're going to have 30% operating margins, then wow, their valuation is going to look good. But if they're going to come back down to 12%, which is probably more realistic, then you have to really ask questions about the valuation. We could take a look at where those operating costs are going. SG&A as a percentage of sales actually peaked back in 2016. The kind of 2016 to 2020 time, it seems to be kind of our best basis for maybe a more normalized period for the company. So I am going to kind of constantly refer back to this 2016 to 2020 timeframe because I think it's the most stable information we basically have is that kind of time frame. So in that time frame, we're also at SG&A as a percentage of sales at 12 to 13%. What's interesting is we could say that that's actually dipped down a bit in the most recent few years, which you could argue that that's also partially where the growth of the profitability came from, is maybe their SG&A hasn't caught up with their acquisitions that they've done recently, for example. And then also taking a break from that, we also have this graph down here showing operating income versus EBIT, which is generally pretty similar to each other, and then the after-tax operating income giving us an idea of our tax rate over time. They had higher tax rates a little bit before, and then we get into kind of the 2016 to 2020 timeframe, where there may be anywhere from 32% down to 18% was the low end. That was also in, super nice tax year timeframe also. So maybe 25 to 30% being a more normalized tax rate for them. Switching over to the cash flow statements, you can see how the cash flow, operating cash flows moved from 35 million up to 787 million over the 10-year time frame. Cash flow from investing was 87 million up to 443 million in the most recent year. And then financing, they were actually having positive issuance of financing on overall net back in 2013. And then in the last several years, it's definitely been much more of a return to capital type of story. Sliding over to take a look at the cash flow graphs as I kind of have over here. We have this chart over here, which shows the cash flow from operations, which is the summation of these in total lines, not including the portion that's negative below the line, the negative portion being negative portions of net working capital, and then the blue being the net income. And then what's added to that is the depreciation, amortization, and stock compensation, and the effective other. So this shows the kind of the difference between cash flow from operations and net income, which they did themselves guide to us that they're expecting to have those things be relatively equal over a 3-year average. And then cash flow from investing we have over here, showing total cash capital investment versus financial or equity investments, if they have any of the company, relatively minor as a factor for them. And then both of those as a percentage of sales, which they themselves also guided that cash capital expenditures they were seeing about 3 to 4 percentage points in the rolling future, which we can kind of compare that to the more recent past, where they've had high years and low years, anywhere from like 1 to 2% negative percentage in terms of the funds that actually can be negative, up to maybe 10 or 11% in certain other years. Free cash flow, showing this graph shows the difference between free cash flow and the after-tax operating income, the blue being after-tax operating income, and then the yellow being free cash flow, and then the red shows the actual net reinvestment, kind of being the netted out difference between the two. So if we switch over to the balance sheet page, we can see the balance sheets with the assets growing from 1.3 billion up to about 2.6 billion. Total liabilities going from 808 million up to about 1.3, 1.4 billion in the most recent year period. Shareholders equity going from 500 million up to 1.2 billion. Retained earnings actually going from negative up to 802 million. So very, very solid growth of the overall balance sheets. And we also have lots of narrowed in specific metrics for the balance sheets. A few specific ones that I'm going to focus on in particular being the sales capital ratio, which is obviously my favorite measure for thinking about kind of capital efficiency over the 10-year time frame, the average being 2.14. So that's $2.14 of revenue for each dollar of capital invested in the business. If we look at the more recent years period, it's been more like $2.50 and a little bit higher that even in the most recent couple of years, as well as they've been buying back their capital. So that's going to be shrinking the capital base. We're expecting a little bit of a decrease in sales, so that would be bringing it down slightly a little bit as well. But overall, it definitely seems to be kind of a somewhat upward trend in the sales capital ratio. And if we also remember, comparing that to their industry, this kind of shows that they actually have a slightly lower sales capital ratio than their industry, which maybe shows potential for moving that upward over the future. Also, returns on invested capital. We can see that returns on invested capital had some negative years in the first few portion of the time frame. When we get to the 2016 through 2020 time frame, we end up with kind of a nice solid average 16 to 17%, and then it's just absolutely exploded in the last couple of years. What with, like I said, the ability to buy back some of their capital, a huge explosion in the overall sales, and good operating leverage as well, and shooting it up over 60% in the most recent year period. The real question is where those returns on invested capital are going to be going over the long term moving forward. I have the current assets as a percentage of total assets, and then showing the percentage, so we kind of get a broad overview of what their assets are like. And then breaking down the current asset components into sections, I have cash and short-term securities, accounts receivables, and inventories, and then percent of assets for the cash, and the percent of sales for the other two. So you can kind of get an idea of where these things move over time. Specifically, obviously, we're focusing a lot on inventories, so we kind of want to take a look at that. You can see kind of an average for their inventories as a percentage of sales. Seems to be in kind of like this 9 to 12 kind of range or so, and they're not necessarily at the higher end of it. They're 11.6% relative to maybe a high point of 13%. Way back in the day, they're at 16, 15% even. So it's like, I wouldn't necessarily say their inventories are high if we're comparing it to their sales. Obviously, if their sales are going to come down, that's going to have a major impact on that. And the question is how quickly can they get rid of the inventories relative to that sales decline? But either way, it's good to be able to break down the current assets into its basic components like that. And then that's obviously the main basis of the working capital. So taking a look at the working capital, I have total working capital in the green, and then non-cash working capital, where I subtract out cash and short-term securities because I don't consider that part of the invested capital. And then both of those as percentage of sales. So getting an idea of just like the actual working capital in terms of like more thinking of it as an asset. And then the non-cash working capital, which is thinking of it more as like a capital investment. So getting an idea of like how much of that is as a portion of sales. Long-term assets, we can break those down and get an idea of just how much of those is a percentage of the total assets. And then liabilities, we have the current liabilities as a percentage of the total liabilities. And then we break down the current liabilities into components just like we did with the current assets. Short-term debt, accounts payables, and deferred revenue for companies where that's going to be more relevant. Interesting to see that they do actually have this kind of growth in deferred revenue in the last few years when they didn't really have deferred revenue in the past. It doesn't really make up a huge percentage of sales though, so I don't think it's super relevant to the story. We don't really need to build projections based off of it if it's only 2 to 3%. But also I did kind of see this this payables, the percentage of sales dipping down pretty solidly. So it's very nice to see them trying to manage those payables on the kind of the horizon of concerns about profitability. They're paying out their bills and then kind of waiting for more cash to flow in terms of the receivables. So the receivables dip down, but not quite the same level in terms of relative to sales. In fact, the actual nominal amount of receivables went up, as we can see here, versus the nominal and the percentage went down for payables. And then, as I kind of promised a little bit ago, we have this cash conversion cycle chart over here, which shows us the ability for them to pay down their inventory in terms of their sales, basically showing, relatively speaking, how much of their sales is their inventory stacked up against, showing basically overall that yeah, it's kind of stayed in kind of a consistent pattern. It moved upward over the 2016 to 2020 timeframe, dipped down in 2021, and then dipped up a little bit in 2022. So I would say their days inventory outstanding is a little bit high, shows that they do have to go through quite a bit of sales in order to pay through all the inventory relative to maybe 2016, 2017, but not necessarily super high. It's kind of stayed consistent. So I wouldn't say the last 2 years are problematic in that sense. We can see the payables and the receivables, which is days sales outstanding, have their own kind of pattern within, where the day sales seems to be kind of separating a little bit from the payables, which shows, as we kind of had talked about, the fact that they paid down some of their payables while the receivables they still have a decent amount of, and that kind of gets us the overall trend in the cash conversion cycle, where we actually do want to see their ability to get the cash break down into a shorter amount of days. It was kind of building up a little bit higher, going from this kind of 60-day kind of time frame up into 70s, up to 80s, and then it dropped down in 2021, showing that their ability to actually convert their earnings into cash really accelerated in 2021, and then it's pushed back up in 2022, but it hasn't pushed back up necessarily past the longer term average. So I would say that their cash conversion is still relatively good. So with that, that's all of the details related to our financial statements spreadsheet that I kind of wanted to show you. A lot of it was related to the company specifically, but a lot of it was also me just trying to give a general overview of what the new format of the spreadsheet has to offer, because I'm going to be going over these metrics week in and week out, or on whatever basis I choose to be making these videos moving forward. So this tool is probably the simpler of the 3 tools. It just kind of have a couple key features, which is really more of us taking a look at how the company has performed in a market-based sense. I have on this graph right here the performance of the company's total return versus the S&P 500 total return, which, as you can see, the S&P 500 is pretty flat, relatively speaking, against it, which is to say it's not actually flat up at all over the time frame from mid 2016. It's up about 115% or so, give or take, while it's just that Atkore has massively outperformed, being up over 600% during that same time frame. It's pretty interesting to see kind of the ebb and flow between outperformance and underperformance, where we can see that, for example, the outperformance up in 2017, where they were up over 65% versus the index being up over only about 12%. That's easily 5x of the outperformance, versus, as we can see here, we're kind of in somewhat of a similar category, maybe 5 to 6x of outperformance. Obviously, this chart really begs the question of whether or not they could possibly crash so far as to come back down to underperformance, which would really mean that they'd have to come down well over 75% from their current level. Though obviously, taking a look at this chart, it seems to show that they have managed to defy gravity in the last year or so, with the vast majority of equity markets having a little bit of a rough time. So who knows, maybe that time is coming for them. So switching over, taking those total returns, I actually did make a calculation of the beta of the company. We're not necessarily using this beta for anything related to the actual valuation. I'm just kind of taking a look at the beta and thinking of it more as a statistical number that gives us information about how the company has performed. And I'm really just thinking about the way the metrics of the statistics themselves is kind of useful to think about the performance of the company. This is something I do with my own portfolio. I think that taking a statistical beta is pretty useful. Now, this is a weekly 2-year beta. Specifically, what that means is it's taking the weekly total returns of the S&P and regressing against the weekly total returns of the stock, and it's doing it over a 2-year period. And now what we have here is that for Atkore, the average weekly return was 1.2%, which is pretty insane with a standard deviation of 7% or so. If you annualized up that 1.2%, it would end up being about 82 to 83% versus the weekly return of 0.1% for the S&P 500 and a standard deviation of less than 3%, which annualizes up to 6.5% or so over a course of a year. They're correlated with the S&P about 53 to 54%, and they have total covariance, R squared measure of 28 to 29%. That means that, effectively speaking, with this statistical regression, the returns of the S&P 500 explain the returns of Atkore up to about 29%. Now, what that also implies, therefore, is that there is an unexplained 71% of returns. 71% of the returns of Atkore cannot be explained by volatility, is basically what that means. Some more of the statistical information that's related to it. Eventually, it gets us to the beta calculation of 1.5, when it's actually a statistical range of confidence anywhere between 1.68 and 1.32% or so, which gets us a midpoint of 1.5. The Jensen's alpha, which compares the actual annualized returns over the entire time, or the weekly returns over the entire time frame, to the expected returns as we kind of calculated, gets us a Jensen's alpha of about 1%. 1% per week, which means the expected returns based off of volatility would have been 0.2 per week. Again, the S&P 500 performed 0.1. So effectively speaking, volatility would have expected them to do double the S&P or so, and they just massively outperformed it, 12x it or so. The annualized level of the expected return, which means if they performed in accordance with volatility, it would have been a 15% annualized return expected over the 2-year period. Instead, it was achieved a 67% outperformance relative to that 67%. As we saw, they actually gained 82 to 83% over the last 2 years annualized relative to the 15% expected. So insane outperformance. And this is one of the reasons I think it's interesting to take a look at that beta, because then you get that idea of 71% of the returns not coming from volatility, coming from somewhere. The fundamentals of the company, maybe, the strategic operation of the entrepreneurs that work in the business, maybe, or maybe it's just a small cap. Maybe it's just lack of information within the inefficient markets, or one of the other factors that you could try to base it against. Now, switching over to this other page on the pricing spreadsheet, I've also taken a lot of the fundamental data from the financial spreadsheets that I put together, and along with the pricing information of the stock over the last several years, and then we kind of combine the two so we can get an idea of various pricing metrics like the PE ratio, the EV to sales ratio, and the price to book ratio. But I wanted to do the calculations myself. I know there's lots of other websites and services that will show you what the PE ratio has been like each day over the last 5 years for a company or something like that. But I have my quibbles about how metrics are calculated. I like to calculate the PE the way I want to calculate it. I want to make sure we're using a diluted share count the way I want it to be calculated. I want the price to book to be calculated the way I want it. And I also do my own adjustments to earnings as well as price to book metrics, depending on whether or not I'm using R&D calculation or lease capitalization. So the point is, sometimes I have my own adjustments that I want to include as well. So the point is, either way, I like to trust my own calculations. So I decided to build a spreadsheet showing me the PE ratios and the EV to sales ratio and so on over time. So I have here 4 charts. This is the 1-year chart. We also have 3-year charts and 10-year charts as well. They're effectively speaking the exact same 4 charts, just over those different time frames, so that we can kind of take a look at this relatively simply, I think. So here we have, for example, the price of the stock versus the share count over the last year. We also have the EPS and the adjusted EPS, which are effectively the same for Atkore, because we don't really have any differences in R&D capitalization or any other capitalization methods. But the point is there's 2 items in the legend here, because theoretically there could be 2 metrics on the graph if there were a difference in this, but in this case it's just more simpler. So either way, we have the EPS and the adjusted EPS growing over the course of the 1 year, and then the PE ratio or adjusted PE ratio over that same time frame. So we can see when there's a growth in the EPS, when the new report comes out, whether or not there is a likewise reaction in the stock. Though we haven't actually accounted for the release date, technically speaking, of that time frame. So you could perfect these charts a little bit by adjusting for when the information became available, but that is what it is. Simple enough. We also then have the EV to sales ratio, but what I have backdropped against it is the revenue, which is the sales being used for the calculation. But I also decided to include the net cash, which is cash, short-term securities, but I also included long-term non-operating investments as well as minority interests. Now, why I included these metrics specifically is these are all the things that I would add onto the market cap in order to correctly calculate the enterprise value. So the sales as well as the additives to enterprise value are the two things I kind of want to look at when I'm trying to think about, well, what is making the EV to sales ratio what it is. So that shows the EV to sales ratio over time. And then we also have the book value per share, as well as, like I said, we can also have an adjusted book value per share versus the price to book and the adjusted price to book. And then, as I kind of promised, we did the exact same charts for the 3-year chart. So we have the PE ratio for the last 3 years, the EV to sales ratio for the last 3 years, and the price to book ratio for the last 3 years, showing how those operating metrics have changed over that same time frame. And then we also have the same metric over a 10-year chart, although because of the fact they IPO'd in 2016, this particular company actually only goes back as far as 2016. But for any other company, these charts would be a 10-year chart. So either way, pretty interesting to see how these things have changed over time. If we're taking a look at maybe, for example, over the longer term time frame, because of the fact we had negative EPS, this chart's a little bit hard to look at. But maybe if we focus in on the EV to sales, you can see EV to sales has been pretty consistently hovering in maybe like a 1.5 to 2 range for a lot of the history of the company. Kind of accelerated up in 2020, and then it's kind of normalized back down a little bit, relatively speaking. Price to book has had a little bit more ebbs and flows and the kind of movements between it, but seems to kind of have been anywhere between 3 and 8 or something over any kind of normal time frame. The midpoint between that would be like 5 or 6 or something like that. So you can get an idea of something like that. Maybe focusing on the last 3 years, we can see maybe like the average PE ratio for the last 3 years has maybe been something in the range of like an 8 or something like that. I don't know, hard to say exactly. And then EV to sales ratio may be something in the range of a 2. And kind of on a basis relative to that, you could say that they are relatively cheap on a PE basis and relatively cheap on an EV to sales basis, though obviously we're expecting earnings to decline because sales are going to decline. So both of those things can be explained away by metrics like that. So anyway, because it's a pretty good idea of the pricing, relatively speaking, for Atkore, pretty cheap on most bases, you can see, though as we've said, that there's obvious reasons why it is cheap. So with that, I popped over here to the main valuation spreadsheet, which is the meat and potatoes of the actual calculations of what we got going on right here. But obviously the operations of the business and their financial history and getting an idea of what they do is much more important to really having any sort of confidence in the assumptions that we're going to be baking into this spreadsheet as we work right here. Starting with a few specific kind of extra details, the kind of like additives that have to be done in terms of the overall calculation of the spreadsheet. Our share count that we're using for the calculation is 46 million as a diluted share count. The total debt that I have, including lease liabilities for the company, is about 904 million at a weighted average approximate interest rate of about 4%, weighted average debt maturity of about 7 years versus their cost of debt, which is still about 4% or so. So the market value of the debt is basically the same as the total debt. Either way, that gets us market debt to equity ratio of about 15 to 16%, which, if you'll remember, is not too dissimilar from the expectations of their industry. I have a chance of operating failure for the company of about 0.5%. That comes relative based off of my looking at the gross and net debt versus the operating cash flow ratios, as we were talking about, and net debt versus EBIT ratios. Overall, I'm expecting a pretty small chance of failure for the company over the projection timeframe. The company does not have long-term non-operating investments, nor do they have a minority interest that has to be accounted for, so we don't really need to focus on any assumptions related to that. So with that, we can actually get into more of the operating assumptions based around the company. I have the different assumptions on different pages, one page for growth, another one for operating margins, another one for capital expenses, and then another one for the discount rate and terminal growth, all of which will build into the final summary. It's a bit complicated, the overall spreadsheet of how we've set things up here. I have a bull case, a base case, and a bear case for each of those pages. And then each of the bull case, base case, and bear case can get assigned a different probability. So we have a different pathway for each of these bull, base, and bear cases, and a different probability between that, which then all calculates together, multiplying all against each other. 3 outcomes against 5 variables is 3 to the 5th power, gets you 243 different valuation outcomes, all of which we then distribute in a large valuation distribution. You'll see what I mean here in a second. So either way, our bull case scenario, we have a set of growth over the next 5 years, which averages out to something around 10% sales growth per year for the next 5 years, and then it would start to curve downward towards a terminal growth rate of 4% in the future after that, with about a 30% probability assigned to that. Then I have on the base case an average of about 3% sales growth per year for the next 5 years, where it would then curve down to a sales growth of about 2.5% thereafter. And then in the bear case, I have an average of about 7%, negative 7% sales growth per year, where it would then curve towards an average of about a 1% terminal growth thereafter. 20% for the bear case, 50% for the base case, 30% for the bull case altogether. That gets us an expected revenue in the next year of about 3.5 billion. In 5 years forward, it'd be 4.6 billion, or in 10 years, I'm expecting 5.7, 5.8 billion. That's a 10-year sales growth CAGR on expected basis of about 4% per year. As I had said, we have the different outcomes kind of distributed in different growths right here. You can see this was the per year sales growth kind of in a chart. This shows the cumulative sales growth in a chart across the different outcomes, and this shows the incremental sales growth for each of those outcomes per year across the different outcomes as well. Switching over to the margin page, we have, as I had promised, a bull, base, and bear case with different probabilities for each of them for this as well. For example, we have for the bull case an average of 24% operating margins for the next 5 years, where it then moves downward towards a 15% terminal operating margin, and that's 25% chance of happening. Then we also have a base case of about an 18% operating margins for the next 5 years, which would then come downward towards a 13% operating margin, would come down towards a terminal 12% margin in the terminal year, and that's a 55% chance of happening. And then we have a potentiality for a 10% operating margin, which would come towards a 10% terminal operating margin and 20% chance of happening. So you can see different outcomes associated with this, and these outcomes are independent of the growth outcomes. That's something that has to be understood. Each of these bull, base, and bear cases is separate from these bull, base, and bear cases, which is why we have different probabilities associated with them. And we're taking all of these probabilities into account when we build our final valuation. Then I also have a tax situation. They have a starting net operating loss of about 9 million, and then we're going to move towards a terminal tax rate of 25% in the terminal year. For our capital assumptions, we have a starting sales capital ratio of 2.22, and I'm assuming that in a bull case, they might have a sales capital ratio of about a 3 over the 10-year time frame, and a 20% chance of that happening. In a base case, I'm assuming the sales cap ratio would be about 2.5 for the first 5 years, and then it would move down towards 2.25, and I'm assigning about 60% chance of that happening. And then the bear case, I'm assuming they start at 2.25, it moves down towards 2 over the first 5-year period, and then it stays at 2 for the next 5 years after that, with a 20% chance of happening. With all these assumptions in place, that gets us an average invested capital for the next 5 years of about 1.8 billion. And for the next 5 years after that, maybe 2.5 billion, ending at an invested capital expected maybe 2.6, 2.7 billion. That gets us an implied return on invested capital on average for the first 5 years of 27, 28%. That would move down towards maybe 22% for the next 5 years. And then for the full 10-year period, an average return on invested capital of about 25%. So you can see the free cash flow that we end up with that. We have free cash flows in the most recent year of 350, which is taking into account the last trailing 12 months, and the free cash flows would start off relatively high as we had large capital investment in that time frame, including the acquisition. So it would start off bouncing up relatively high. Then we would have a relatively lower cash flows as we have to do some larger capital investment, and then it would move up towards about 450 million in expected free cash flows in the terminal year or so. We have also graphs showing the kind of range of the returns on invested capital over the 10-year time frame, the kind of ranges of the capital investment per year over the 10-year time frame, and then the distribution of free cash flow outcomes in the terminal year. So you can see the vast majority of outcomes, free cash flows in this kind of 400 to 450 million time range or so in the terminal year, but it could be anywhere from 200 million to possibly 800 million, as you can see with the vast majority of outcomes being around here. We also have discount rate assumptions. We have the discount rate in my bull case assumption being 9% at the start, moving towards a little bit of a higher risk period of about 10%, and back down towards 9% in the terminal year. I kind of keep this pattern where I'm seeing a little bit more higher risk in the 5 years forward as a capital investment starts to have to be caught back up with it. I'm expecting a little bit of a higher risk during that time frame for most of these cases. So we see the same thing for the base case. It moves from a 10% cost of capital up to about 11% cost of capital. back down to a 10% cost of capital. And then the bear case, it slightly diverges from that, where we actually see it just increase and then increase again over the next 5 years in that particular case or so, with about 20% of outcomes for the bull case, about 20% for the bear case, and 60% for the base case. Now we also have a separate set of probabilities for the terminal growth rate. I have the terminal growth in my bull case being 4%, bear case being 1%, and then the base case being 2.5%. So that's my kind of expectations for terminal growth. If you take all those assumptions together, that gets us an implied 10-year average excess return of something like 16%, 14 to 16%. That's excess return. So that's returns on invested capital above and beyond their cost of capital. And then the excess returns we see in the terminal year is still pretty high. We're still seeing about 10% excess returns or so beyond that. Now, generally speaking, you should be very hesitant to give any company terminal excess returns, just because that means you're effectively assuming that they can have excess returns forever. But this is a relatively small company, and they've managed to be super controlled and measured in their capital allocation. So I can actually potentially see that being the case for them. And with all of these assumptions, that actually gets us to our total valuation or so, with the expected 10-year free cash flow, the 10th year free cash flow being 459 million. Our cost of capital in that particular case on expected basis being 10.3%. We end up with a fair value for the stock of being about $99.34 per share. That value is 21% or so higher than the current share price. And based off of that and the cost of capital that we're using into the future, gives us an implied 10-year expected return of 7.7% per year for the next 10 years. Now, we did build a distribution across the different sets of variables as we kind of discussed here. So we do actually have a distribution of outcomes shown here, as well as a distribution of expected returns, which correlates with these fair values. So I also actually included the quartiles of the outcomes shown here, showing that the median outcome is actually a little bit higher of free cash flow and a little bit higher of a cost of capital, but that cost of capital is really just with the outcome that's associated with this in particular. But the median outcome is actually about $95.30 per share at 24 to 25% higher level than the current share price, and an 8.9% expected returns. But either way, it also shows that the first quartile of outcome shows a $72 fair value versus the third quartile outcome being $124. What that means is that at the first quartile, it means if you purchased it at $72.50 per share, based off these assumptions, there would be 3 times as many outcomes to the upside as there is to the downside. Versus if you bought it at $124 per share, there would be 3 times as many outcomes to the downside as there is to the upside. And so that's kind of the difference between quartiles. And I think it's more useful to think of valuation in terms of quartiles. And we can see that kind of shown here in the distribution. It's like the median case is obviously right here, with the average being slightly higher than that. But then the quartiles are basically like here or so. So it shows that really half of the outcomes are here. You can really just ignore these super unlikely to happen outcomes. So that's the idea of thinking in quartiles. Then I also have this summary page over here where I do show the expected case for each of these variables displayed in a more traditional DCF style, as you can kind of see right here, with all of the extra assumptions that need to be in place right here, getting us to the same expected value that you see on this page over here on net. And it also shows that the current price that it's currently trading at, $126.16 per share, is at the 76th percentile of that valuation distribution. So it means it's at this 76th spot or so in the distribution of outcomes. And then I also do have a summary of basically all of the same graphs that you see on the other pages kind of put together in this one page. And so all of this together, this is the new format for our valuation spreadsheets. It definitely is a bit worried to get through all of it, and I'm going to be working on trying to figure out which sections I think are the most core elements that need to be shared in a video when making these presentations, as well as there was a lot of elements of this of me doing some explaining more than just showing, because it is the first time I've shown these spreadsheets in particular. But I do hope the new format is pleasing to everybody. Everybody really likes all the work that went into this. I was working on these spreadsheets all of last year. Like I said, it was originally intended to be one specific project that kind of turned into several side projects related to the main core project on the whole of it. But either way, I'm very pleased with the outcomes of it, and I'm very excited to be using them moving forward. So I'm happy that we finally managed to integrate them into our evaluations. And I hope you guys enjoyed this valuation I gave you of Atkore here today. If you have enjoyed it, it would be really appreciated if you would give us a like, subscribe to the channel if you haven't already, join the Discord. The link is in the description below. If you haven't joined already, it's one of the best ways to be a part of the kind of channel community. And also it's one of the best ways to give your input on which companies we should be valuing next, which if you have a suggestion for companies that I should be valuing next, please go ahead and comment it below. I often put polls on the channel in days following these valuations with suggestions of companies I'm thinking about doing valuations in the future. And then, as I said below, there is that link to the Discord. What are you doing? Join the Discord. Come be part of the group. Give me suggestions of companies that we can value in the future. All right, I'll catch you all again next time.